Get ready, because the financial universe is shaking and Bitcoin Bulletin is your exclusive front row seat. We're diving headfirst into a news cycle that's moving at warp speed, bringing you the updates you absolutely cannot afford to miss. We're starting with a deep dive into corporate finance and why the future of balance sheets might be exclusively Bitcoin. This isn't just about holding digital assets, it's about understanding which ones have the true staying power and why. Then, we shift gears to the pulse of the global economy. A single economic report is on the horizon, and analysts are warning it could be the make-or-break moment for Bitcoin's current trajectory. We'll break down what this critical data means for the market and how it could impact your investments. Next, we're looking at a significant move by a major Bitcoin treasury company. A reverse stock split is making waves, sparking intense debate and raising serious questions on Wall Street about potential Bitcoin dumping. We'll explore the implications of this strategic maneuver. Finally, we're celebrating a monumental milestone in corporate adoption. Public companies have now collectively surpassed 1 million Bitcoin holdings. We'll break down who the major players are and what this massive accumulation signifies for the future. Stick around, because you're about to get the intel that matters. Hit that subscribe button and ring the notification bell so you never miss a beat. The corporate balance sheet revolution. Forget what you think you know about digital asset treasuries. A seismic shift is underway, challenging the very foundation of how public companies manage their reserves. While the allure of digital assets has led some to explore allocating funds to various cryptocurrencies, a compelling argument is emerging that only one asset truly belongs on a corporate balance sheet: Bitcoin. The landscape is evolving rapidly, with companies experimenting with what are being termed digital asset treasuries or DATs. The pitch sounds familiar: acquire digital assets, establish a treasury strategy, and aim for long-term upside. However, this comparison often collapses under scrutiny. Many companies are now reportedly pivoting towards DAT models, allocating reserves not just to Bitcoin, but also to altcoins like Ethereum and Dogecoin. On the surface, the strategy might seem like a logical extension of early adoption, but a closer look reveals a fundamental misunderstanding of what makes an asset suitable for institutional-grade treasury management. Bitcoin, unlike its digital counterparts, is not merely a tech platform or a product in development. It is money, purpose-built, neutral, and characterized by maximal conservatism in its evolution. Its rules are immutable, its issuance schedule is locked in stone, and its design is fiercely resistant to arbitrary changes. This inherent stability and predictability are precisely what corporate treasuries require. They are tasked with preserving and growing shareholder value over extended periods, a mission that demands resilience, discipline, and clear capital frameworks that withstand market cycles. In stark contrast, altcoins like Ethereum or Dogecoin are better characterized as venture-stage software projects that happen to have monetary features, rather than true money. Their evolution is often driven by governance decisions, protocol upgrades, and the inherent risks associated with software development. This introduces a layer of complexity and uncertainty that is antithetical to the core function of a treasury, which is capital preservation. The difference is akin to choosing between a meticulously engineered vault designed for security and longevity versus a prototype vehicle that may offer exciting performance but lacks proven reliability and safety standards. From a capital stewardship perspective, Bitcoin's design aligns perfectly with the goals of a corporate treasury. Its properties reward conviction over time, becoming more defensible and less risky the longer it is held. Altcoins, conversely, invert this logic. Their value proposition often depends on continuous innovation, adoption of new features, and navigating the complexities of decentralized governance. This creates a tension for treasuries. The longer an altcoin is held, the more governance, execution, and regulatory risks accrue. It becomes progressively harder to justify the allocation. Bitcoin, on the other hand, becomes easier to justify over time. It is the only digital asset where deeper holding reduces tail risk. For public companies, capital strategy must prioritize durability, auditability, and market trust. Allocating to altcoins introduces risks that undermine these fundamental goals. Building a corporate treasury on tokens with malleable rules, weak settlement assurances, and governance opacity is not a bold move. It is a reckless one. Bitcoin stands as the exception, not just because it was first, but because its architecture is uniquely built for enduring value preservation. Public companies adopting Bitcoin are not simply making a bet on the broader crypto space. They are making a strategic decision to upgrade the foundation of their capital structure with an asset that offers unparalleled clarity, certainty, and durability. Bitcoin's uniqueness is not an ideological stance. It is a structural reality that positions it as a modern balance sheet anchor in an era marked by currency volatility, escalating debt, and institutional distrust. But will this focus on Bitcoin's unique properties be enough to weather upcoming economic storms? Next, we'll analyze a crucial economic report that could drastically alter Bitcoin's market trajectory. Economic crossroads. Will jobs data redefine Bitcoin's path? The global financial markets are on edge, with a singular economic data release poised to dictate the immediate future for Bitcoin and the broader crypto landscape. The upcoming August ADP Jobs Report is not just another economic indicator. It's a critical signal that could influence Federal Reserve policy and, consequently, the risk appetite for assets like Bitcoin. Analysts are closely watching this report as it could significantly impact Bitcoin's price, potentially shoring up its $107,000 lifeline or pushing it into more volatile territory. The market's current sentiment appears to be leaning towards a bad news is good news narrative, where weaker economic data is interpreted as a catalyst for the Federal Reserve to cut interest rates. Such a move typically boosts risk assets, including cryptocurrencies. However, the line between optimism and panic is razor-thin, and the report's outcome could swing either way. The median forecast from a Reuters survey anticipates only 65,000 jobs added in August, a noticeable drop from July's 104,000. The range of estimates, from 35,000 to 105,000, underscores the deep uncertainty surrounding the labor market's health. A print significantly below these expectations would likely strengthen the case for a September Fed rate cut. Yet this positive spin on rate cuts is tempered by the increased concern about the U.S. economy potentially sliding into a recession. This dual impact, potential rate cuts versus recession fears, creates a complex environment for investors. According to analysis from Bitunix's analyst desk, Bitcoin's liquidation heat map indicates immediate support around the $107,000 to $107,200 zone, with resistance building up between $113,000 and $113,500. At the time of reporting, BTC was trading near $111,000, caught precariously between these key levels. If the ad print comes in weak, BTC could find support from renewed rate cut expectations, though volatility risks would simultaneously increase, Bitunix analysts cautioned. This delicate balance highlights the market's current psychology. Traders are betting that a subdued jobs report will compel the Federal Reserve to ease monetary policy, a move historically favorable to risk assets. However, a slight miss might lift sentiment, while a substantial downside surprise could trigger widespread panic, leading to a sell-off. The ADP report serves as an early preview of the broader U.S. employment situation, preceding the more closely watched non-farm payrolls, NFP, report scheduled for Friday. For crypto traders, the immediate implications are significant. Downside momentum could accelerate if Bitcoin fails to hold the crucial $107,000 support level. Conversely, a decisive break above the $113,500 resistance could potentially open the door to higher trading ranges, as analysts noted. Nevertheless, a prevailing sense of caution persists for the longer term. Even if weaker data sparks a short-lived rally, persistent recession fears could ultimately cap upside momentum across both traditional and digital asset markets. The ADP report will be a key signal for the U.S. labor market this week, Bitunix reiterated, advising investors to remain vigilant for potential volatility whiplash. The outcome of this single report could very well determine whether Bitcoin maintains its upward trajectory or faces renewed headwinds. But even as economic data creates market uncertainty, strategic corporate maneuvers are drawing scrutiny. Now, we'll look into a reverse stock split by a major Bitcoin treasury company that's raising eyebrows on Wall Street. Wall Street watches as Bitcoin treasuries reverse split sparks dumping fears. In a move that has sent ripples through the financial community, a prominent Bitcoin treasury company has initiated a reverse stock split, a corporate action that has ignited concerns among Bitcoin enthusiasts and Wall Street analysts alike about potential future Bitcoin sales. The company, Sequins, has undertaken this reverse split as a strategic measure to regain compliance with the New York Stock Exchange, NYSE, listing requirements. Typically, a reverse stock split consolidates existing shares into fewer, proportionally more valuable shares. This is often done to increase a stock's trading price, making it appear more substantial and potentially avoiding delisting from major exchanges. For Sequins, the immediate goal is to meet the minimum share price threshold mandated by the NYSE, ensuring its continued listing on the exchange. However, the timing and nature of this corporate action have not gone unnoticed by the cryptocurrency community. The concern stems from the potential implications for the company's Bitcoin holdings. While the reverse split itself does not directly involve the company's digital assets, it is often a precursor to actions that could lead to the liquidation of those assets. Companies facing financial pressure or seeking to bolster their liquidity often turn to their treasury reserves to meet obligations. In this case, a significant portion of Sequin's treasury is held in Bitcoin. The Bitcoin community is particularly sensitive to any actions that might signal a potential sell-off of the digital asset. Given Bitcoin's limited supply and the growing trend of corporate adoption, any large-scale selling by a major holder can significantly impact market dynamics and price. The fear is that Sequins, in its effort to strengthen its financial position and maintain its stock market presence, might be compelled to sell portions of its Bitcoin reserves to cover operational costs, debt obligations, or to fund its strategic initiatives necessitated by the reverse split. Analysts are weighing the strategic necessity for Sequins against the market's sensitivity to Bitcoin supply dynamics. While the company's primary objective is to maintain its public listing, the market's interpretation of this move is crucial. The narrative around corporate Bitcoin holdings has largely been one of long-term conviction and strategic accumulation. A reverse split, especially if perceived as a sign of financial distress or a precursor to selling, could challenge this narrative and introduce a bearish sentiment. Furthermore, the move comes at a time when corporate Bitcoin treasury strategies are under increased scrutiny. As more companies add Bitcoin to their balance sheets, the market is keenly observing their treasury management practices. Any deviation from a clear long-term holding strategy, particularly one that involves potential liquidation, could influence other companies' decisions regarding their own digital asset allocations. The community is watching closely to see if Sequins can navigate this compliance challenge without resorting to significant Bitcoin sales, which could disrupt the delicate balance of supply and demand in the Bitcoin market. The situation highlights the complex interplay between traditional financial compliance and the burgeoning world of digital asset treasuries. It underscores the need for transparency and clear communication from companies holding significant Bitcoin reserves, especially when undertaking significant corporate actions that could be misinterpreted by the market. This corporate maneuver raises questions about treasury management, but a much larger milestone in corporate adoption is also making headlines. Prepare yourself, because we're about to reveal just how much Bitcoin public companies are now holding in total. Public companies smash 1 million BTC milestone. A new era of corporate adoption dawns. In a landmark development that underscores the accelerating embrace of Bitcoin by the corporate world, publicly traded companies have collectively amassed over 1 million Bitcoin, a staggering milestone valued at approximately $110 billion. This surge in corporate holdings signals a profound shift in how traditional businesses view and integrate digital assets into their financial strategies. According to data from BTC treasuries, the collective holdings now stand at an impressive 1,632 BTC. This figure highlights the significant impact of corporate treasury strategies, with MicroStrategy, MSTR, continuing to dominate the landscape. The business analytics giant holds a colossal 636,505 BTC, representing approximately 63.6% of the total corporate holdings. This single company's aggressive accumulation strategy has been a key driver in normalizing Bitcoin as a corporate reserve asset. The top 10 public companies alone account for a substantial 863,397 BTC, demonstrating a concentrated level of adoption among major players. Beyond MicroStrategy, other significant holders include MARA Holdings, MARA with 50,639 BTC, CME Group, CEP with 43,514 BTC, Bitcoin Standard Treasury, BSTR, with 30,021 BTC, and Bullish, BLSH, with 24,000 BTC. Further down the list, Metaplanet Inc. MTPLF holds 20,000 BTC, Riot Platforms Riot has 19,239 BTC, Trump Media and Technology Group, DJT holds 15,000 BTC, CleanSpark, CLSK, possesses 12,703 BTC, and Coinbase Global Coin rounds out the top holdings with 11,776 BTC. This trend of corporate accumulation, which gained significant momentum with MicroStrategy's initial move in 2020, appears to have reached a frenzied inflection point in recent times. While the pace may have cooled slightly from its peak, with Bitcoin's overall market dominance easing and its price experiencing fluctuations below recent record highs, the sheer volume of accumulation remains a powerful testament to the growing institutional confidence in Bitcoin. The narrative surrounding corporate Bitcoin holdings has evolved considerably. Initially viewed as a speculative venture, it is increasingly being recognized as a strategic financial decision aimed at hedging against inflation, diversifying reserves, and potentially capturing long-term value appreciation. Companies are leveraging Bitcoin's unique properties, its scarcity, decentralization, and censorship resistance, as a modern-day store of value, akin to digital gold. Despite recent market pullbacks, with MicroStrategy experiencing a roughly 30% decrease from its mid-July peak and Metaplanet shedding about two-thirds of its value since its late May high, the long-term conviction among these corporate holders appears unshaken. These fluctuations are often viewed as short-term volatility within a broader, long-term accumulation strategy. The collective ownership of over 1 million Bitcoin by public companies is more than just a financial statistic. It represents a fundamental validation of Bitcoin as a legitimate and valuable asset class for institutional investors. It signifies a paradigm shift, moving Bitcoin from the fringes of speculative investment to a core component of corporate financial strategy. This milestone is likely to encourage further adoption, creating a virtuous cycle of increasing demand and reinforcing Bitcoin's position as a critical digital asset in the global financial ecosystem. And that wraps up our deep dive into today's top stories. Don't go anywhere, because we've got a lightning round recap coming your way right after this. That's a wrap on today's explosive Bitcoin Bulletin. We've seen how corporate treasuries are increasingly focusing on Bitcoin's unique strengths, navigating economic signals that could shape the market, and witnessing a monumental milestone with public companies now holding over 1 million Bitcoin. If you got value from this deep dive, smash that like button, subscribe for more unmissable updates, and ring the notification bell so you're always in the know. Share your thoughts in the comments below and follow us on all social platforms for real-time insights. We'll see you in the next one.